Good morning and welcome to the Energy Perspectives Group webinar hosted by Solaris Resources. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Yeah, welcome everybody. Thanks for attending. I'm really excited to bring Solaris Resources to you guys. They hosted a luncheon for us a few weeks ago in Houston, and we got to learn a lot about the company. But this is an outstanding copper exploration company. They've got a nice asset with lots of proven copper reserves, Warintza project in Ecuador. And that's what we're going to kind of focus on today. But our speaker today is Daniel Earl. He's the president and CEO of Solaris Resources. Daniel has over 17 years of experience in the mining sector and capital markets, covering projects ranging from early stage exploration through feasibility and engineering to production. He's a graduate of the Mineral Engineering program at the University of Toronto. He is based in Toronto. And Daniel is currently the president and CEO of Solaris and also serves on the board of directors. He also sits on the board of directors of Augusta Oil Corp. Prior to joining Solaris in November 2019, he was a vice president and director at TD Securities, where he covered the mining sector for over 12 years and established himself as a thought leader in the space. Prior to joining TD Securities in 2007, he was a senior executive with a number of Canadian and U.S. public mining exploration or mineral exploration and mining companies. So now I am going to turn the controls over to Daniel for an update on Solaris Resources and the company's flagship asset, which is the Warintza project, a significant copper discovery in Ecuador. So it's all yours, Daniel.
Thanks so much for that, Dan. Really appreciate it. And it's a pleasure to be here with all of you. As Dan was saying, we did an in-person session down in Houston a few weeks ago, and that was a tremendous group there. Some really sophisticated questions coming through. A lot of engineers in the audience who really understood the issues that affect the resource sector in general and are relevant to, of course, companies like Solaris Resources or Warintza project. But I'm excited to be here with the webinar audience. I understand there's great distribution, and I hope that this is the beginning of a conversation, and we can and have an ongoing dialogue and update you as we continue to make progress with this company. So again, my name is Daniel Earl, President and CEO of Solaris. I've been with the company since its founding a few years ago. And prior to that, spent a dozen years working in capital markets, covering the mining sector for a Canadian investment bank. And then prior to that, working in industry itself, in various roles with junior public companies. So in one way or another, my entire career spent in the mining sector. I thought for this presentation, what we could do is just put some context around the Solaris Resources story by first talking about copper and the copper market dynamics. I think that helps set up an understanding of kind of our strategy and how this Warintza asset fits into the industry as a whole as we start to kind of move forward into the more exciting part, I think, of the copper market story. So let me start with that, and then we'll get into Solaris itself. I think obviously the place to begin with copper is just in the kind of deterioration that we've had in market sentiment, and this is obviously driven by the fears around a decline in global growth and even outright recession in Europe, and the fear of the same in the U.S. And also China, of course. China, different set of issues there. It's people being focused on the ongoing property correction and then the economic impact of the zero COVID policies that they have. But all of these things kind of coming together with the Fed hiking cycle and inflation fears and so on has just led to this real retrenchment in sentiment. And of course, this deterioration in sentiment drives financial flows. Okay, and that together with the dollar surging has really hit the copper price. So the copper price has come off something like 30% from the highs, but it's now, I think, stabilized. Obviously, there's still quite a bit of volatility in this sort of environment, but I think you're starting to see some stability come through in the copper price. So about a 30% sell-off in the metal. The copper-focused equities have sold off anywhere from, say, 50% for market leaders like Freeport-McMoRan to, larger losses, 70% in the case of earlier stage companies, explorers and so on, like Solaris. So that's a really dramatic sell-off for copper equities, basically baking in, kind of those recession fears that we talked about, even if they haven't, materialized. Okay, so what I want to be clear about, though, is that that's driven by sentiment, and the actual fundamentals need to be distinguished from that kind of, sentiment-driven sell-off that we've seen, because the fundamentals have softened somewhat, but not nearly to the same degree as that kind of 30% price drop in copper metal would imply. Okay, and then this sell-off actually, I think, is going to exacerbate the supply crunch that is coming in a couple of years. And that's a very important, obviously a key part of the story for any copper projects. Okay, so but let me just spend a second on the fundamental picture. So of course, demand has come down, as you would imagine, but supply has come down alongside it. Okay, and this is primarily driven by some of the issues in Latin America. Latin America in the copper sector accounts for about 40% of supply. And the two key jurisdictions to focus on are Chile and Peru, the global #1 and #2 copper producers. And there's a whole range of issues in these countries that are bringing down supply. But broadly, what you've got is a shift towards socialism with some of the elections and political trends in those countries, with far left activist governments that have been elected, and this has resulted in a regulatory and an environmental crackdown, and then also talk of taxes being raised very significantly on top of the general inflation, so the underlying inflation that you had in the industry anyway. So this is obviously things you're aware of, like the surge in the price of diesel, things you may not be aware of, like the sulfuric acid price, which on its own has added something like $1 a pound to producers of cathode copper from SXEW processes, a subset of the market there. And then electricity prices. In Chile, electricity prices are up 70%. Okay, so you've got this crackdown happening, the heightened risk environment, the threat of higher taxes, and then the whole cost structure just being lifted higher by something like $1 a pound. When the copper price is $3.50 and your costs have gone up by $1 a pound in the span of about 2 years, that is a massive issue. And I think you can understand the kind of impact that would have, both in limiting near-term supply, but then also contributing to kind of the lag in new production coming on, which sets up and exacerbates the kind of supply crunch that was already baked into the cake. Okay, so demand down, but then supply down alongside it. Okay, let me spend just a second talking about China. China is really critical to pay attention to in the copper market and resources in general, but in copper, China accounts for about 50% of demand. And the Chinese economic cycle is offset from the US and Europe, or rest of world collectively, business cycle. And it's been that way since the beginning of the pandemic. And when we look at China, what we see is that demand has, demand expectations, have slowed alongside economic growth. Okay, so the economic growth expectations for China at the beginning of the year would have been around, 5% GDP growth. And more recently, those have been revised down into the range of sort of 2 to 3% GDP growth for this year, before rebounding to sort of 5 to 6% next year on most people's estimates that I've seen out there. Now, copper demand itself, that's economic growth. Copper demand itself is surprisingly strong, I think, for most people. We haven't actually seen copper demand in China fall at all. In fact, it's up slightly from expectations at the beginning of the year. And this is because of a structural shift in China, okay, where you've got a heavy government policy-driven investment in the build-out of the grid, so bringing on additional capacity, bringing on the transmission network, all the transmission lines and substations and so on to move around more electricity. And then the renewable sector, the transition to electric vehicles in that country, and then all the related energy storage to support the stability of the grid alongside it. Okay, so grid investment in China, the copper demand from that segment is actually up about 10% across the year. EVs and renewables are up something like 80%. And this is, again, this is a policy-driven industrial macro trend that you're seeing play out in China. And we're in the early innings here. This is, obviously supported by heavy government spending. We're talking about $200 to $300 billion a year of spending in China to achieve the high-level strategic goals that they've set out. To be at peak carbon emissions by the end of this decade, and then full carbon neutrality by 2060. And underlying that is a desire to dominate all the key sectors, technological sectors, to support that. So dominating solar, which they already do, but dominating the rest of the renewable space, dominating electric vehicles, which they're already making tremendous progress towards. And then all the smart grid technologies and the other underlying technologies that are part of that. Okay, and so China, if you think about China's overall economic picture now, it's been a year of retrenchment because of the issues that we talked about. I think we're at a potential turning point now. The People's Party Congress is set for, the major meeting on the calendar is set for Sunday, the 16th, if I recall correctly. And I think coming out of that, you'll see that the zero COVID, while not abandoned in name, is loosened up on. The policy support continues to come through. The infrastructure spending starts to come through in earnest. The funding and refunding for the property sector begins to come through. And so overall, a much greater focus on delivering an economic growth rebound and achieving their targets coming out of the People's Party Congress than you've seen in the year to date. Okay, and this is the dominant factor to focus on in China, is this policy. In 8 of the last 10 years in China, the dominant factor has been policy, okay, which is a very different set of considerations than, in free markets like or relatively free markets like Europe and the United States. Okay, and again, this is the dominant driver for copper. All right, so that's the kind of the recent history, and I think the near term picture. Okay, we've had a sharp decline in the copper price, an even sharper decline in the equities. We seem to have found some support. There's even reason in China, I think, through the People's Party Congress and into next year to be relatively optimistic. Okay, but the fireworks in the copper space really start, I think, from the middle of next year onwards. Okay, I think that is the point where the market is going to begin to focus on the structural bull market that's forthcoming. This is a kind of a period of open-ended deficits, eventually leading to an inventory stock out, which begins in 2024. So I think that'll begin to be priced in 2023, and then it'll actually be upon us in 2024, where we have inventories being depleted and eventually reaching stock out kind of conditions in 2025 and 2026. And this is, I mean, you'll be familiar with the basic framework for this in other resource markets that you're looking at. You've got, on the one hand, a lack of supply investment, and this is now locked in the copper sector. and this is where it's different than, for example, the oil and gas sector, is because of the lead times for projects. Copper projects are multi-billion-dollar projects. They take years to bring through feasibility study. They take years to permit, years of construction, and then years to ramp up. And so it's a very long lead time from when an investment decision is made to when you actually start to see metal getting delivered into the market. And so the basic framework for supply is, with small margins around it, locked in through the end of the decade. Okay, and so that's basically the supply picture that we have on the one hand. On the other hand, you've got a structural bull market, which is driven by an underlying kind of growth driven by population growth and industrialization and and economic growth, and use intensity, all this sort of stuff. Basically, your traditional end uses for copper. And then superimposed on top of that, you've got the global energy transition. Okay, so this is electrification, decarbonization, path to net zero, however you want to frame it, on the other hand. And what this presents is a picture where you're going to have increasingly large supply deficits that build out to the end of the decade and then beyond. Okay, so by the end of the decade, we're talking about, call it 8 to 10 million tons per annum supply deficit. And long before we get to that point, we'll have a complete stock out of inventories. And if you want to think about a comparable for what this is going to look like in copper, think of what you've seen in the lithium market, okay, which is part of the same sort of phenomenon, but obviously occurred earlier because of the use intensity for these electrification and renewable uses that it has done for copper, which is still dominated by the traditional end uses. Okay, so in lithium, we've seen the lithium price up 85% this year, and that's on top of being up, something like 450% the year prior. So you put that together, you're talking about nearly a 10-fold increase in the lithium price in a short period of time. That is a market where you've got, through the price channel, industry bidding for all available supply. And basically every lithium project being an economic project, if it's technically feasible, and being pushed forward. Okay, that I think that dynamic is what we have to look forward to in the copper sector. And I think the market probably starts pricing that next year, and then it's upon us the year after that, and then building out through the end of the decade. Okay. And so in terms of bringing this back to the equities are forward-looking. They'll price this in the same way that they've sold off 50 to 70% and are basically pricing in, the global, worst fears of recession across, Europe, the U.S., and China's version of a recession, their equivalent version of a recession, low, single-digit percentage growth rates. They're also going to rebound ahead of the market. So as soon as we see the bottom in the kind of the revisions to the global economic outlook and a stabilization, I think that you'll see a lift in the copper equities. And long before we get to the point where we've got structural deficits coming through and inventories declining from what are already low levels, you're really going to start to see the copper equities take off. Okay, and so we're not talking about 20 to 50% returns or even 100% returns. We're talking about hundreds of percent returns to get these equities back to even the position that they were at. Okay, so I'll leave it there. That was kind of a long-winded approach to a market framework, but I think it's so important to understand that what we're not talking about a normal cyclical kind of troughing and rebound. We're talking about a structural, secular bull market driven by global macro trends on top of that. Okay, and that's really, I think, where you generate the outsized returns in this sector. Okay, Let me turn to Solaris. This is obviously a copper growth story. It's focused, like Dan was saying in the introduction, on our Warintza project in Ecuador. I always acknowledge, with this slide here, the picture of the gentleman at the bottom center of the slide, the credit for this discovery goes to David Lowell. This was arguably the world's greatest mine finder. Certainly in the copper sector, that's true. He made more than a dozen major discoveries, including the largest copper mine in the world, which is the Las Cadetas mine in Chile. That mine is more than twice the size of the second largest copper mine in the world. Okay, and so really with Solaris, what we're doing is we're bringing his vision for the Warintza project to its full fruition. And even beyond Warintza, we've got a portfolio of assets elsewhere in the Americas, which represent David's targets for future discoveries. Okay, so a full portfolio basically of David's projects that we're going to be advancing in this company. Now, the focus, very clearly, the focus here is on Warintza. This, we think, is the best greenfield copper development opportunity on the board that majors are going to be picking from to restock and position their pipelines, so their project portfolios for this structural bull market in copper, which is only a couple years out now. Okay, and so that's where the focus is. We recently released an updated resource estimate for this project back in April, outlining a 1.5 billion ton resource. This was at our central deposit, and we've now added 3 additional discoveries around that to make a total of 4 deposits that we've discovered on this property to date, with the central deposit accounting for a 1.5 billion ton inventory, which is already on its own a world-class inventory. When we talk about world-class copper projects, you're largely talking about open pit projects. There are very few underground projects that you would say have the production potential to be considered a world-class asset. And in large-scale open pit mining, the cutoff for a world-class project, a top-tier project that any of the largest players in the industry would be looking for, is at the 1 billion ton mark. So we're 50% through that on our central deposit. We've got 3 other discoveries that we've made around that, which represent a runway for multiple times growth beyond the resource that we have. Okay. Now, there are 2 key differentiators to understand with this resource beyond the size of it, which I think really separate this project from other large-scale projects that are out there in the industry. The first is the starter pit. This is a unique feature with our resource at Central that you don't see elsewhere. The second is just the cost intensity, which is a very low-cost environment in the district that we're located in Ecuador, and because of the specific characteristics of the project we have. Let me focus on the starter pit though. Okay, so what this is an area of higher grade mineralization that you can mine right from surface in the early years of the mine plan at Warintza Central. Okay, and we define this in that in the resource that we published in April at a little over 280 million tons at 0.8% copper equivalent. Okay, and the analysts who cover the company, we haven't published our own economics, but the analysts who cover the company suggested that material would get you something like a $50 a ton margin. Okay, and if you're producing 40 million tons per annum at a $50 a ton margin, that gets you to about $2 billion a year of EBITDA potential from this starter pit. And that would run at that throughput rate, that would run for 7 to 8 years. Okay, at the front end of nearly a 40-year mine life at that kind of throughput. Okay, and if your project only costs $2 to $3 billion to build, you're talking about a capital payback period of less than 2 years, which is unheard of for a project of this kind of scale. Generally, for these global scale projects or world-class scale projects, you're talking about a 4 to 6 year capital payback period, and that's for the best projects out there. Okay, so that is why I emphasize with this starter pit, this is a really robust project in terms of its economic potential And that's one of the key differentiators alongside the cost structure, which I think are going to make this, when we talk about this being the greatest project on the board, or one of the most obvious acquisition targets for companies trying to reposition towards copper for the forthcoming bull market that we have. That is what's contributing in a large way towards that potential. Okay, and again, that inventory that I'm talking about, that starter pit, and then that overall resource, that is just the starting point. Okay, so the starter pit, we have a goal of doubling the size of that starter pit with the drill program that we're now, 10 months into this year. And then the overall inventory, we're going to triple the indicated category that we have and greatly expand the overall inventory. Okay, and this is from the growth from our central deposit and then taking in our east deposit. We still have a west deposit, which I'm not factoring in, and a south deposit beyond that, which all represent the future growth potential. Okay, and this is set in Ecuador. I'm going to spend some time talking about Ecuador, but this is one of the few jurisdictions globally, and I think the only one in Latin America now, which is really trying to encourage growth in the mining sector, and doing that with a positive approach of providing incentives in the form of tax and royalty cuts, and then streamlining the permitting environment when the major copper producing jurisdictions are going the opposite way with their regressive policies that they've got. Okay, just moving on. The company is managed by the Augusta Group. Okay, we've got a very simple goal, as we do with all of our companies throughout our history, which is just surfacing the value in the project, the inherent value in the project through exploration, and then crystallizing that through an exit transaction. And that's what we do. That's what we're going to do with this company. It's what we've done with all our prior companies. We've got a track record now over the last dozen years of about $4.5 billion of exit transactions. Okay, and all of them within this niche of exploration and development. So this would include the companies you see on this slide, like Ventana Gold. That was a gold discovery, early stage greenfield gold discovery that we made in Colombia. We built up the value of that discovery from basically zero to where we sold the project for $1.6 billion in 2011. And that was done inside of 3 years. Okay. Augusta Resource, we sold that for $670 million in 2014. Newcastle Gold, this is a gold development asset in California. We actually used it to co-found Equinox Gold, which is now a mid-tier gold producer. And then our most recent transaction with Arizona Mining, this is a polymetallic discovery that we made. So literally made the discovery, not even early stage, but actually made the discovery in Arizona. Built up the value and sold that for $2.1 billion in 2018. Okay, so that's what we do. I want to be absolutely clear. We have no intention of taking this asset into production. We do not want to become a copper producer, have no aspiration to do that. Our strategy, rooted in the skill set that we have, is to just surface the value in the exploration stage and then sell this on to a company that wants to take it into production. And this is the best asset that we've ever had in terms of the scale that we've got. We've never had a plus billion ton asset that looked like it had potential to be 4 to 6 billion tons in time. We've never had this robust of a project in terms of a 2-year capital payback or less than 2-year capital payback potential. The kind of economics and the margins that you see potential for in this district. And then, of course, it's in the most strategic metal now, which is copper, which I think is the only metal that's truly indispensable to this, global phenomena of electrification. It's obviously the metal that is wiring together all these disparate technologies, but has no potential or no risk, let's say, for technical, demand destruction or substitution and so on. And it's the only metal that combines those future-facing characteristics with the scale that's of interest to the global diversified companies, the major copper producers, and even some of these major gold companies that have all signaled a desire to add copper projects into their portfolios. Okay, and it's not just talk. We're actually all in terms of our investment. I mean, I've put everything that I have into this company to get myself the position that I have. Our executive chairman, Richard Warwick, and the founder of the Augusta Group, he's made a major investment, over $170 million of his own cash in the company, and he's going to be investing a further nearly $40 million into this company in the coming 6 months or so, with warrants that he has that are in the money. So that is a massive investment. That is putting, your money where your mouth is on a scale that you're not going to find in, I think, other juniors in the mining sector, whether in copper or in any other metal. Okay, in terms of the capital structure, we're well funded. We've got over $20 million in cash on the balance sheet. And then we've got warrants that are in the money, which will be coming due by the end of the year. And then into next year, we've got another $30 million that are due. These are at $1.20. There is a tranche of warrants, about $18 million or so, that are at 675, so just slightly outside of the money with the sell-off that we've seen. But these are in the hands of our executive chairman. Okay, so he's been the biggest supporter of the company, and I think that you'll see that those get exercised regardless of what the short-term share price would suggest. So very well funded for the program that we have and that we're implementing with this company. The other thing that I'd point out is just in terms of the share structure, you see that the largest owners of this company by shareholding are the management of the company, principally our executive chairman, but then the rest of the management team. Everybody on this executive team has invested significantly in this company. You can go have a look on SETI at the insider filings. It's not just our executive chairman, but everyone on down the list has made a significant investment. And if not, then market purchases in this company to support it. And that's why we have the share structure that we do. We're coming on kind of 2/3 of the share structure that is locked up in management and long-term supportive shareholders. Okay, and I think what this means is really two things. First of all, we're not going to be vulnerable to selling at the bottom, selling in the trough of the copper equity market where we are now. And then number two, that when the rebound does come and you do have a lifting of kind of sentiment in the sector, it's not going to take a lot of inflows and buying in this stock to get it back up above $10 a share, which is where we want to be at a minimum. Okay. So let me leave it there. I'm going to turn to Ecuador. It's worth just spending a minute talking about this jurisdiction. It is a relatively new jurisdiction for mining, but as I was mentioning in my intro, it's one of the only jurisdictions that's got a record since opening up its mining sector back in 2014 of positive incentives to encourage growth in the sector. So this is cutting taxes, cutting royalties, making the fiscal environment more attractive for investment, and then de-risking. So reducing the permitting timeline with regulatory reform, de-risking with some of the other initiatives that they've undertaken in this jurisdiction. And this basic shift towards the mining sector and in favor of the mining sector has actually accelerated under the current president, Guillermo Lasso. He's a conservative. He's got the agenda that you would imagine about private sector economic revitalization in the country. But one of the key pillars is the mining sector as part of his platform. Okay, and so you've got now I think 3 administrations, this being the 3rd administration, that have all been supportive of mining, but now the foot on the accelerator pedal under Guillermo Lasso. Okay, and really what he wants to do is to make this the decade of mining in Ecuador and position the country to step into the role that is being the opportunity that's being opened up by the adverse policy developments that you've got in Chile and Peru, which are currently the world's #1 and #2 producers. Okay, so as they evolve in a kind of a negative way, then Ecuador wants to be able to slide in and capture some of the, potential growth and capital that would otherwise be allocated to those jurisdictions. All right. And okay, so we've seen a number of important policies come through. We've made a number of breakthroughs since releasing that resource back in April. And really what these do, I'll take you through them in order that they occurred. But just so you understand, what we're trying to do is, after having established, that we have a world-class project with the resource that we published in April for our Warintza Central project, the growth around it, the high-grade starter pit, the cost environment, establishing those really robust economics to support that. What we want to do now is de-risk it. So take out the major buckets of risk. Okay, so create the value and then take out the risk. That's the basic checklist that you need to work your way through to set up, the kind of transaction that we envisioned for this company. And so what we did is just basically knock off those major buckets of risk that would attend to, any mining project in any jurisdiction of this kind of scale. Okay, so the first thing, and this is especially important in Latin America and in Ecuador, is taking out the community social relations risk. And we did this by signing what's called an impact and benefits agreement, okay, with the communities which this project resides on their ancestral lands. And we signed up those communities to an impact and benefits agreement in May of this year. And the government attended the signing ceremony for that. The media attended and endorsed that impact and benefits agreement. And essentially what that agreement does is it commits the communities to the support of the project, not just for the exploration stage, which we're in now, but then all the way through construction and development into production, and then all the way through to closure. Okay, so ensuring that we've got community support locked up for the project to support, its eventual acquisition and then construction and development. All right, so that was number one. That occurred back in May. The second thing was taking out the regulatory and the fiscal risk. And we did this with the signing of an investment protection agreement that was announced in June. Okay, what this does is it freezes in place the mining regulations. Okay, so it provides security of title, security of investment, and so on, but it freezes in place the mining regulations. As of the date the IPA was signed, those mining regulations governing this project are frozen. So if you get in the future, when the elections are scheduled in 2025, an adverse administration comes to power and tries to clamp down on the growth in the mining sector for environmental reasons or what have you, this project will still be governed by the regulations as they exist today and as of the signing of the agreement back in June. Okay, so taking out the regulatory risk. This is really critical in the mining sector generally, but especially given the adverse developments that we've seen in Latin America with a trend towards socialist governments, especially in the copper sector in Chile and Peru, which are kind of key destinations for copper investment. Okay, so that number one, and then number two, as part of the same agreement, freezing in place the incentives that this government has brought in. Okay, so what they've done is, through an income tax reduction, through the elimination of import taxes, through the elimination of VAT and other taxes, is they've made Ecuador, under this IPA regime, the lowest tax jurisdiction for mining in South America. Okay, and so the second thing that the IPA does is it freezes in place those fiscal parameters governing the project with one of the lowest tax rates in South America. Okay, down below 40%, when in Chile and Peru, you're north of 50%, and there's a threat of taxes going north of 60%, depending on the way that things evolve in those jurisdictions. Okay, so that's the community risk, the regulatory risk, and then the fiscal risk. So the risk of taxes going higher in the future, we've mitigated that with this investment protection agreement. Okay, and what that leaves is one major risk factor, which has become an increasing concern. Jurisdictions globally with kind of a heightened sense of sensitivity around ESG and environmental issues is timeline risk. How quickly can you get a project like this from the exploration stage through engineering and then through permitting to a point where you can actually break ground on a construction project? Okay, so that timeline risk has been lengthening and lengthening in other jurisdictions globally. And the key development for us was having the project designated as a strategic priority project in Ecuador. This also occurred in June. The government actually announced it at the PDAC conference in Toronto. This is one of the largest global mining conferences that happens annually. The government sent a large delegation and announced that we were the newest strategic priority project in the country. And so this allows for the project to have direct presidential office oversight in all of its regulatory approvals. And basically, the government with this announced a timeline for the project to be permitted in 2024 and go into construction in 2025. And so the inset that you see on this slide is actually lifted directly from the government's presentation to the PDAC conference. And you can see the timeline for our project there. Okay, so this is a government that's serious about the growth of the mining sector. They've put in place this IPA framework that we've been able to take advantage of. They've de-risked the permitting timeline for us, which we've also benefited from. And it's not just us, they're doing this with other projects in the country as well. So just in the last few months, we've seen 2 new mining projects approved in the country. Smaller scale project, one small scale certainly, and then one moderate scale in other parts of the country. But this is happening in Ecuador. It's no longer just government policy that's being put in place. It's the actual project permits going through, the investment protection agreements going through, and then I think the next wave you'll see major investments, acquisitions announced, and then major investments announced off the back of that. Okay. And so that is what I described to you. That is basically, once you set up the value of an asset, just working through the major buckets of risk that attend to mining projects and just mitigating them with the work that we've been able to do with our communities and then our government partners with the announcements that we've made over the last few months. Okay, I'm just going to turn to the district that this project is located in southeastern Ecuador. This is really important to understand. What you have here on this slide, this is southeastern Ecuador, and this is the only major mining district in Ecuador. You've got the largest mine in the country, Mirador. This is an open pit copper mine about 40 kilometers down the highway from where we're located. It's operated by the Chinese, and it's a very low cost mine. It's certainly well inside the lowest cost quartile for the global copper industry. And basically, it's analogous to what you might envision for our central deposit. Obviously, when you look at the full Warintza project, you'll see we've got much greater scale in this project, but it's basically an example of all of the natural advantages that attend to the central project that are translating to low costs at Mirador. Okay, and these are the things that you see here. Obviously, it's the highway system, which we just talked about, connecting up these projects from a logistical standpoint to get supplies and consumables in, equipment and consumables in, and then get the product shipped out. There's short haul distances to get out to the Pacific ports. There's 4 different port options that you have that connect out to markets in Asia. In this case, in Ecuador's case, 100% of the oil and all of the copper offtake is going directly to China. China is the major, investor in the resource sector in Ecuador. Okay, so that highway system, running along the highway system, you've got a power grid. This power grid in Ecuador is very well supplied. There's abundant power that's available. It's low cost, clean, renewable hydroelectric power. Okay, so stable, power cost around 7 cents a kilowatt hour. It's very attractive, but not subject to inflation the way that we see in Chile, where to the extent that the mining company is not supplementing their power supply from renewables, a lot of them are supplemented by, solar power in Chile. But for the power that's coming off the grid, prices have escalated by 70% this year. Okay, so that's a grid that's, supplied by coal power and by other fossil fuels, and prices have, escalated sharply in Chile. Whereas in Ecuador, you've got completely stable, power pricing off the grid because it's dominantly from hydroelectric sources. About 87% of the power is from hydroelectric. Okay, low elevation. This is maybe not so obvious. Here in this part of Ecuador, elevations on our property are entirely under, 6,000 feet or so. When you're talking about the major copper producing districts in Chile, they're up north of 12,000 feet. Some of the newer projects are even north of, 15, 16,000 feet. Costs are obviously, much higher. It's difficult at those kinds of elevations to even walk around, let alone to, operate a complex, large scale mining operation. So the elevation, that's another one. Labor in Ecuador. Labor in Ecuador is half of the cost of what the unionized labor is in Chile. For all the major copper projects, it's unionized labor at something like double the cost of what labor is in Ecuador. And the final one is just the fresh water. We've got fresh water. It's freely available. There's no cost attached to that. A very little capital that would be attached to, securing the water supply here in this mining district. Whereas in Chile, this is a major issue. This is a politically sensitive issue. It's basically the situation that for all new mining projects in Chile, they're going to have to be creating their own water supply with desalination at the coast. And the construction of these desalination plants, you're talking about a +$1 billion capital item, and then additional costs for the pipelines to get the water hundreds of kilometers inland to the main producing copper belts and kilometers up in elevation towards your project. Okay, so and that's just CapEx on the front end of the project, undiscounted negative cash flows on the front end of your project. If you're building a desalination plant, you've got that additional project CapEx. Your project is worth that much less on a net asset value calculation. And conversely, in our situation, worth that much more without that CapEx attached to the project. And you can see the proof of this in Mirador. Mirador captures all of these things and proves the capital intensity of this district, both on the operating cost side and then on the CapEx side. It's why a project at what I would consider global scale, 40 million tons in Ecuador, in the case of Mirador, was a $2 to $2.5 billion project, where a project at a similar sort of scale, so again, global scale, 50 million tons, recently completed in Chile, Teck's QB2 project, was a $7.5 billion project. Okay, that is the difference in cost intensity that we're talking about in one of the most expensive regions on earth, in the high Andes of Chile, versus one of the least expensive here in this district in Ecuador. And that all just goes straight to that capital savings, just goes straight to the bottom line in terms of a net asset value calculation and the value that's inherent to an asset like this. Okay, in terms of the resource, I spoke about it briefly earlier. We published a major resource update. We put about 18 months of drilling into getting to that point and published it in April of this year. And this was to establish the world-class credentials of the project. We had targeted and told the market from the beginning of the Solaris story that we were shooting for 1 billion tons in an open pit. Okay, and we came in at 1.5 billion tons, a strong grade, low strip ratio, just in our central deposit, but crucially front-end loaded in terms of a grade profile with a high-grade starter pit, okay, which gives you the really robust economics. And that was about 18 months of drilling to the end of last year. Obviously, we've been drilling since that time. Okay, so the entire time we've been drilling, we've delivered a significant amount of growth since that time in the drilling results that we put out. We've got a backlog of results that we're sitting on, which are going to be coming out between here and the end of the year, which are going to demonstrate further growth. And the two key goals that we had with this year's drilling program are to take that starter pit, which is so key to the economics, and then to at least double the size of that. We're going to do that with the drilling that we're doing at Central, as well as at our East deposit, and then take the indicated category resources, which are in the 500 to 600 million ton range currently, based on an April resource, and then triple the size of those indicated resources. It's those indicated resources that'll contribute to an eventual reserve estimate, which is why they're so critical in terms of an objective for growth here. And again, this is just the beginning. This is not the end point for this project. This is really just the beginning of the story. This is the Central deposit plus our East deposit that we're now talking about in terms of the drilling program this year. And then you've still got the West deposit and the South deposit still to come, which is your runway for additional significant growth beyond that. Okay, so on this slide now, we're looking down, so bird's eye view, obviously, looking down on top of the cluster of porphyry deposits that we have here, centered, of course, with our Central deposit, which you see in the middle. And that's basically where our resource is, taking in Central and then the portion of the East deposit that overlaps it. Okay, and so the East deposit in the resource that we published in April, it had 8 holes. Only 8 holes were captured, were drilled into the East deposit at the time of that resource. The Central deposit, we had 91 holes drilled into it to get to that resource estimate. So you can see, I mean, just in terms of, you know, comparing the number of drill holes into it, you can understand how much more drilling and growth is still to come in that East deposit. Okay, and just visually, you can look at the area which is open for growth within that anomaly in the blue, which is completely untouched by drill, and that's the focus of the drilling at the East deposit here. Okay, but at the Central deposit, there's a lot of important drilling that's still going in here. Remember, the key at the Central deposit was to double the size of the starter pit. So we were at 280 million tons at 0.8 in the drilling up to the end of last year. You can see in the inset on this slide what we call the Northeast extension area and the growth that we've been delivering there. This came about because in the drill program last year, one of the highest grade holes that we drilled was right on the edge of the drilling that we've done in support of that resource. So it was literally the second last press release of drill results that we put out before cutting off for the resource estimate, included one of the highest grade holes that we have drilled to date. And that was right at the edge of the resource. So on the next slide, when I show you, you'll see that basically forms the edge of the resource in that Northeast area. And what you see in the inset here is all the drilling that we've done after that. So that large area outside of the drilling that went into the resource, which is covered in the, which is highlighted in the orange color, you can see that extension of what we call the Northeast extension area with consistent high-grade drill results right from surface. Remember, the overall resource is 0.5% equivalent. The high-grade starter pit is 0.8% equivalent. You can look at the drill results there, consistent high-grade results in that area. You can understand that adding, hundreds of meters to the strike length in that area, that we're a long way towards achieving that goal of doubling the size of the starter pit with this drill program here. So the starter pit and then the major growth that you'll see at the East, together with infill drilling, is what accomplishes that set of goals that we laid out for the drilling program this year. And then the west deposit, you see on the left side of the image, this was one of the first discoveries that we made outside of Central. It was the first discovery. So this was in February of last year. You're going to see in the coming weeks that we'll be putting out additional results, basically outlining the potential scale of the deposit there at West. It's not part of the existing resource. We've only put out one hole, but you're going to see in the coming weeks additional holes that really outline the potential for a broad deposit at that West zone. And it's a bit lower grade than Central, a bit lower grade than East. But certainly you can look at the dimensions of that relative to Central and understand that once that's fully drilled off, that you're talking about, you know, significant growth in terms of the tonnage potential and the eventual mine life contribution that West zone will make. So that's coming in the next weeks here. And then finally, while we're on this slide, our most recent discovery at the South deposit. So we actually announced this discovery early this year, back in January. And this is a very large target. It's more removed from our main area of operations and from the main pit at Central, about 3 kilometers down to the south. It makes it a more time-consuming and cost-intensive drilling target, and that's why this is the last target that'll eventually be drilled off to support a resource. But you can see the scale potential there. It's just a very large target. It's something like twice the size of Central, and we've just got a single drill hole into that. We look forward to getting additional drilling into that target by the end of the year. Okay, and so that's the picture there, where you've got 1.5 billion tons in the Central deposit now, but a picture that supports multiple times growth with additional drilling into the future. Okay, just moving on. This is basically a map that's zoomed out a little bit further, again looking down in plan, but zoomed out a bit further and showing the full property package. And what this helps you understand is that this isn't just one cluster of porphyry deposits, but there are a whole set of targets surrounding the Warintza cluster where we've, you know, the only locations that we've done drilling to date that still need to be tested. Okay, and we provided detail to the market in terms of the, you know, the first results from the regional program that we've been able to undertake, having drilled off the resource at Central, you know, in the program last year, and well on our way to a major resource update of the drill program this year. We were able to get out the first results of our regional program, so the targets surrounding that in a release back in June. And I encourage you to have a look at that. It's basically a set of targets that spans the spectrum from additional porphyry deposits, so similar to Warintza Central and East, West, and South. Porphyry targets at Mateo and Media Camino and Cora, and then all the way through skarn targets, which skarn systems can often be part of a porphyry system and make a significant contribution in terms of the overall economics. It's not that they have the same scale, but they can often be very high grade and therefore significant contributors net of those factors to the development of an overall porphyry project. So we see this at examples in Chile and Peru that are notable, and at other jurisdictions. So you've got skarn targets at Justo and Playa, Betty, and Celestina, and even some skarn characteristics at our Gawi target. So porphyry through skarn, and then the most interesting target, I think, is our Kaya target, which is an epithermal target. So that's the opposite end of the spectrum. These high sulfidation epithermal deposits, very large in scale. They can be quite high grade. They're relatively rare beasts to find, but often attend to the same sort of settings as these porphyry systems. And that's a very large scale target. Bear in mind that the scale bar at the bottom right, the Kaya target itself is a multi-kilometer target. It's actually overlain by a sandstone that obscures the system there, probably the reason that it wasn't discovered historically. And we've come in around the margins, the southern margin of that target, with sampling where the sandstone is eroded down into into the valleys, and you can see a cross section through the underlying volcanics, and they're absolutely blitzed with characteristic alteration for a high sulfidation system. So characteristic suite of clays, and then pathfinder elements that are unique to these high sulfidation targets. So that's a very interesting large scale target, if a little earlier stage than these skarn and porphyry targets that surround Warintza. And that's just on the main package of claims. We've got a separate package of claims at Clemente. These have targets of their own. This year's program is the first time that we've been able to get up and put in a program of mapping and sampling at our Clemente target. You know, we've got about 200 rock samples, thousands of soil samples beyond that. And the rock samples are, you know, I mean, these are samples that came from a porphyry deposit. So you've got porphyries there that are well mineralized with copper. Interestingly, quite a bit more gold than our Warintza cluster, and less moly. And then breccias and other things which are located in and amongst those the porphyry samples that we've got. So a bit earlier stage, but a very interesting target at or set of targets at Clemente as well. That's our property package. We're working with the government. We've been real standout leaders in terms of responsible approaches to the mining sector, both in terms of the environmental program, of course, but then the community work that we've done, the first community consultation agreement, community consultation in the country we completed, the first impact and benefits agreement we completed, and all of these programs, the environmental, the social, are programmed to maximize the economic impacts with the local procurement management program that we have in place. All of these are critical to setting a good example for the industry and winning the support of government. And we've been working with the government with the benefit of this reputation that we've developed to try and consolidate the land package here in this belt. The claim system is currently closed in Ecuador, but we think we've potentially found a solution with the government, which could lead to us acquiring more claims in this incredibly prospective belt. So that's our property package, just so that you understand the setting. Just outside of our claims on the western boundary, so on the left side of the main claim package there, you see two deposits that are noted, San Carlos and Pananza. These would be considered world-class deposits in their own right. Okay, these are held by the Chinese. Between the two of them, you've got nearly 1 billion tons of high-grade mineralization, much like our central deposit. And these projects are owned by the same Chinese company that operates the Mirador project about 40 kilometers down to the south in our belt. So a very prospective belt that we're looking to try and expand our footprint in. Okay, and the purpose of this is really to, and this will become more clear when I turn to the next slide and we talk about valuation, but the purpose of this is really to preserve the value inherent in the exploration potential of this property package that we won't be able to capture in an exit transaction, which will be entirely about Warintza Central, Warintza East, and maybe the growth potential of West and South, you know, in a better market would factor into it. But basically, we've got all this additional discovery potential surrounding that immediate Warintza cluster of porphyry deposits, which we want to preserve for our shareholders. And so what we've done is we've announced that we're going to have a spin-out company called Solaris Exploration. We will spin 100% of the shares of this company out to our shareholders when we're able to secure a transaction for Solaris as a whole. So each of our shareholders will be getting fractional shares in Solaris Exploration, and that'll take on all of the surrounding targets beyond this Warintza. So all the targets that we talked about, which span the spectrum from porphyry through skarn to epithermal, on the Warintza property, and then on the Clemente property, and then any additional property that we're able to add with the work that we're doing with the government will be in that Solaris Exploration. And that'll be the successor company. So even if we can't get full value on Solaris, given the market conditions, we'll eventually be able to make it up to our shareholders with the spin out company, according to our strategy. Okay, and with that, I'll just turn to this this final slide here on in terms of valuation. And I think what you see here, these are, to be clear, these are not our own estimates. These are from the group of analysts that cover our company. So we've got half a dozen or so sell-side equity research analysts who publish research on Solaris and have provided valuation estimates for our Warintza project. And you can basically see the range of estimates from the pure value of the Warintza Central resource that we published back in April, which gets you about $24 a share, to the potential upside value, taking in some of the growth that we hope to at least deliver in the drill program that we have this year, which would get you up to about $29 value. This is net asset value, okay? So industry standard discount rate of 8% for base metal projects, long-term consensus pricing for the underlying copper price. This is the net asset value of the project based on that resource. And it's a lot of value. I mean, this is what you're seeing here is a world-class scale resource, and then the impact that you have from front-end loading the economics with the high-grade starter pit, so bringing the cash flows forward, the highest cash flows in the early years, and the low cost intensity, both on the CapEx side where you're saving billions of dollars, which goes straight to the bottom line, and then on the OpEx side beyond that. So that's a lot of value that you have. Obviously, the stock has sold off significantly, so we're down, in excess of 50%, 60% with this company in the market downturn that we've had. And it's basically our job from here through the end of the year and into next year, where we think that we'll have a more favorable market environment, to win this value back for our shareholders and then put a premium on it in an exit transaction per our strategy. And we've done this before. In fact, in all of the world-class discoveries that we've made as the Augusta Group, we've been dealing with similar sorts of corrections for different reasons through the history of those companies. And you see the two examples here that I would highlight for you. Ventana Gold, that was an original discovery that we made. So starting with a property with zero value, built it up to about $1.5 billion of value, and then experienced something like a 50% correction over a period of 6 to 12 months in that company before we were able to kind of turn it around, capture that value back in the market by continuing to advance the project, and then securing a premium for it on an exit transaction. Same story for Arizona Mining, different set of circumstances, obviously different project, different jurisdiction, different stage of advancement, but basically the same thing played out. Project with negligible value, made a world-class discovery, built up over $1 billion of value, 50% correction, and then bringing it all the way back and putting a premium on top of that in an exit transaction. We ultimately sold that company for $2.1 billion. So that's the job that we have here in front of us with Warintza. We're not going to be able to capture, full value, 100% of net asset value with Warintza the way that we did with Arizona Mining, because of the market environment that we're dealing with and because how much value there is in the asset. But we're going to secure a chunk of that with the spin-out company, 100% of which is going to go to our shareholders, and hopefully in time we can get that full value delivered to our shareholders. So that's the story of Solaris. That's the story of Warintza. And I'm going to leave it there, and I'll take any questions if there are any.
Yeah, good job, Daniel. Yeah, I got some questions that had been emailed to me. I think you've answered most of these. Let's see. One is the Augusta Group has a strong track record of discovering and then selling proven resource plays for a significant profit. In your opinion, is this a good time to sell Warintza? I think you're coming in. Can you spin out the other exploration assets and sell the company itself, or would you just be selling the asset?
Okay, yeah, that's a great question. I think let me answer this by just pointing to what we've seen in the M&A market in terms of the way that the way that industry is feeling about the M&A environment right now. Okay, so what you've got is, despite the decline in the copper price, so copper price off 30%, doom and gloom in terms of the economic forecasts out there, you've got major diversified companies bidding billions of dollars for assets right now. Okay, so Rio Tinto, $4 to $5 billion hostile bid for Turquoise Hill, which is an operating asset that they already have a stake in Mongolia. Okay, and then more recently, BHP, and these are both companies that are, $60+ billion companies. Okay, companies that generate, plus $10 billion a year of free cash flow each year. And these companies have both signaled a desire to, transition their portfolios away from, these kind of, traditional use metals like iron ore and so on, to future facing metals. So in Rio Tinto, they've acquired a couple lithium projects. They're obviously now bidding for a major copper asset, but there's a lot more work to do. And then the same thing for BHP. Okay, so not so much in lithium, but obviously now bidding for major copper assets. Okay, so that tells you that they're keen to acquire copper assets. On the flip side of that, you've got the companies that hold the assets. Okay, and their stocks are down 50 to 70%. Okay, so they've taken a massive haircut in terms of asset value. They're not keen to sell. Okay, because they're looking at the same, on both sides of that, we're looking at the same outlook for the copper industry. Whatever you think the trough is going to be in terms of the bottom of this cycle, a couple of years hence, we're going to be looking at structural bull markets and much higher prices. And so the sellers are not keen to let go of assets at these kinds of depressed prices. And so in the case of Turquoise Hill, it went multiple rounds with multiple bids before eventually there may be a deal now. And with BHP and Oz Minerals, we'll see what happens. So I guess that was an indirect way of answering the question. Now is not a good time to sell.
Yeah.
Now is not a good time to sell. Now is a great time to buy. I think there's a lot of appetite to purchase these assets. You've seen the diversified companies make the first moves. You've seen even gold companies like Agnico Eagle enter into a very significant transaction with Teck Resources to acquire an interest in a copper project. Other gold companies like Newmont have signaled an intention to add copper. Barrick has been vocal in their CEO, Mark Bristow, about a desire to add copper production to their portfolio. What's missing, and I think what will be coming and should be a focal point for investors, are the Chinese companies. So both state-owned enterprises and then private or partially private companies, let's say, which haven't been present in the M&A market to date. But in every base metal cycle that we see, by the end of the cycle, the Chinese companies are the most active. And typically where they play is where they can apply their skill set, which is in low-cost construction, supply chains, low-cost labor, and so on. So they'll be playing in the, sorry, I apologize for that. They'll be playing primarily in the exploration and development space, which is always where the M&A cycle, evolves to. After starting in the producing space with the first series of transactions that we've seen, 3 transactions last year, multi-billion-dollar transactions, 2 more, multi-billion-dollar transactions this year, all of them, with one exception, producing assets. And then the next leg of the market will be focused on advanced development assets and then exploration assets.
Yeah.
And really for Solaris, the way that we position ourselves with this asset and its world-class credentials, and then the de-risking around it, is to just make sure that when M&A does move into development assets, that we're the first off the board.
Well, let me ask you this. Okay, so you've got the backing of the government, it sounds like, got the backing of the local community, but will they support, like, if a Chinese buyer comes in, is that a problem? Maybe you don't care if they buy it from you, but does it matter who bids on the property? they're going to have to go through that whole process of getting support from the locals and the government?
It's actually a great question, and you've hit on something that I think is really important to understand in terms of how the mining sector has evolved and the way that the map has shrunk for Chinese companies. It used to be that Chinese companies could buy assets, pretty much anywhere in the globe, in kind of friendlier times. Let's say in the last commodity super cycle that we had in the, from the sort of mid 2000s through to 2010. But we're in a very different landscape now, where it's unimaginable that a Chinese company could acquire, say, a large open pit, copper development project in the United States, for example,
Right.
or even I would say in Canada or Australia, the same is probably true. So the map has shrunk for Chinese companies, but the demand hasn't. They still need it. The demand obviously has grown and is set up to grow for the future with the way that they're trying to, the industrial strategy that they have to transition towards, electrification and so on. So Ecuador happens to be a jurisdiction that they absolutely are welcome in. So they're the largest sovereign creditor in Ecuador. And so they actually just renegotiated a portion, about $1.4 billion of the sovereign debt of Ecuador. And this is, this came about from the president going hat in hand to Beijing, for meetings with Xi Jinping to make this deal happen. They're negotiating, they have an MOU in place. They're in the process of negotiating a free trade agreement with China. China has 100% offtake on 500,000 barrels a day. Substantially all of the oil production out of Ecuador. They own the largest copper mine in the country. So they're major players in Ecuador.
Yeah.
There is sensitivity at the community level. You're not wrong, because we don't want to see a company come in with, an old-fashioned, sort of legacy approach of bringing in all Chinese labor and,
Right.
just putting a development in that doesn't meet international standards. So there is some sensitivity there. You've got to be careful to make sure you've got the right Chinese partner, because they're not all the same. There are, very progressive companies that rank right alongside BHP and Rio Tinto in terms of their international ESG ratings. And then obviously there are companies at the other end of the spectrum that you wouldn't want to be getting into bed with. So
yeah. Well, does the government have to? Do they get a voice in approving the buyer?
Well, there'll be approvals like with the sale of any company, which is what we're talking about here. There are approvals both in Canada and then in Ecuador.
Oh, okay.
And these are generally so when you've seen issues in Canada for the sale of assets, it's because they've been strategic assets in Canada. So like a gold mine in the Arctic, for example, a Chinese company bid for that, and that was rejected by the government, probably because of national security concerns. But uranium assets and then some of the pipeline assets have been rejected by the government of Canada. And so that happens. I can't think of a single example where an overseas mining asset acquisition has been rejected by the government of Canada. And then on the Ecuador side, there's no chance that that's going to happen. I mean, they're too deeply beholden to China to ever even think about doing something like that.
Yeah. Well, I'm going to get into another topic, and I'm super bullish on copper myself because I don't see a substitute for it. I mean, this electrification of everything, there's no other metal that can be used to, move electricity around other than copper, right?
There are other metals that have low resistivity and conductivity properties like copper, but there's nothing that there's nothing in the same sort of cost. Like no one's going to be using silver,
right,
to replace
25 times more. Yeah, right.
And transmission lines. I mean, it's just not going to happen. There is some talk around substitution with maybe in certain applications you could substitute copper for aluminum, but the cost of doing that, you need to get to a $10, or $12 copper price before that begins to make sense. So
Yeah.
It's not technically impossible, but from a practical standpoint, with the pricing environment that we have, it's going to be very difficult. And the thing I'll say about aluminum is it suffers from the very same issues that are driving this this bull market in copper. Aluminum is basically electricity in metal form. It's you take alumina, you zap it with all kinds of electricity, and then that's aluminum. So
yeah, and the European aluminum producers are being shut down because of their high electricity prices.
Because of the energy crisis.
Yeah.
So you can see, I mean, Dan, we've talked about this before. You can see the circular loop that you get into trying to actually deliver this electrification transition. There's all sorts of challenges.
Yeah, there's just not enough stuff. I mean, there's not enough material. I mean, Clifford, I don't know if you look at the chat box, but I saw that same presentation this professor made to the Paris Climate Accord people, and he said, you would have to mine more copper than has ever been mined in the history of human existence to support your, total elimination of fossil fuels, which, anybody that's on this should know by now, that is never going to happen. They just can't understand the scale of what they're talking about.
Can't happen. And the thing that's unique about like copper is that the biggest and the best and the highest grade projects, they've all been mined. Like, this is an industry that's dependent on the mega mines to satisfy demand growth. Okay, so like something like 25% of all production is coming out of the top 10 global copper mines. And these mines were discovered decades ago. Every time that there was growth in copper demand, these mines were expanded. Some of them have been expanded 4 and 5 times, and they're actually a source of, supply deterioration from 2024 onwards, because you've got these massive mines, which you've got reserve depletion, you've got grade decline, you've got the water issues, which we talked about in Chile, which are a huge limiting factor. You've got electricity issues, you've got physical space issues. These mines have peaked basically already and are going to start rolling over from next year. And that's basically just a huge structural challenge that the industry has in front of it to maintain supply, let alone to deliver the kind of really rapid supply growth that's required.
Well, when I make a presentation on the oil market, I always tell people the cheap stuff has already been harvested. There's no more cheap oil. We're not going back to $10 oil anytime. It's same thing with mine. If you have to go deeper and deeper to get the ore, it's getting more and more and more expensive. So those costs have to be passed on. Plus, you just have overall inflation factor anyway. But I get all the time, well, what at the beginning of the pandemic, oil actually went negative, which it only did on the futures market. But we did flop around in the $20 range for a long time. But that's a totally unsustainable level. And it's, even now, probably in copper, you're at close to an unsustainable level if you want to get more exploration work done, correct?
Yeah, not only that, Dan, but people don't understand the way that the cost structure has lifted in this inflationary cycle.
Right.
So
yeah.
people's understanding of what costs are is based on, historical precedent. It doesn't apply in this inflationary cycle. Like we talked about Chile, for example. That's the world's #1 copper producer, just shy of a third of global copper production in Chile. The cost structure in Chile, as a result of the diesel price going up, sulfuric acid prices up fivefold, and electricity prices up 70%, water prices way up, labor prices. Every union worth their salt went on strike multiple times across the pandemic with lifted metal prices to secure higher pay. The cost structure in Chile as a whole is up over $1 a pound. The copper price is only $3.50. So it's a massive just structural shift in the cost structure higher at the same time as you've got all these risks being poured on governments, lengthening permitting timelines with the regulatory paralysis, adding additional costs, adding taxes because they, want to fill the holes in their budgets. from their, largesse in social spending as a result to respond to the pandemic. It's a toxic cocktail for the industry. There's no question.
Well, you showed that chart at the beginning about how in about 2025, 2026, that demand's going to exceed supply. But that doesn't really require all of us going to EVs or anything, correct?
No, absolutely not. Well, I don't think it's possible.
I just don't think it's possible.
Yeah,
I just don't think materials are there to build them. It's not going to happen. And people are not going to throw their internal combustion vehicle away anyway. So outside of a very small number of wealthy people that want to show off that they drive an EV, I don't think the EV market's nearly as big as everybody thinks it is. But I think the electrification, the grids have to be built. People want a higher standard of living, and that's having electric appliances and stuff. All that demand growth is there just because of population growth. So anyway, I see the shortage. It's the same thing that's on the energy side. I just wonder, and you comment on this, the situation in Europe this winter, I think is going to be terrible. I think they're heading into a winter where people are really going to have trouble, if they can get it, paying for the price to heat their homes, much less they may actually be burning wood and, coal, to heat their homes pretty soon. I think that's going to get a lot of citizens saying, hey, we need to rethink this Paris Climate Accord stuff. And it just may not be possible. But regardless of that, we all want higher standards of living, and that's where the copper demand is going to be coming from.
Well, yeah. Well, what you're talking about there, higher standards of living. It's not so much in the developed economies, right? Because we already have a high standard of living. If your wealth doubles, Dan, you're not going to consume more copper necessarily. Maybe you buy another car or something, or a vacation home or something, but you're not going to say double your copper use intensity. But when you look at emerging markets, so when you're thinking about India, you're thinking about Africa, like where a lot of the population growth is going to come from,
right?
Over the balance of the century, but then also where the use intensity really picks up. If you go from living below the poverty line to being merely poor, your use intensity for metals skyrocket. Like it's an order of magnitude higher consumption,
right?
Because now all of a sudden you've got shelter. You might have some electronics and so on. And if you go from being poor to being middle class, now all of a sudden you've got a house, you've got a car, you've got appliances. Your use intensity, goes up multiple times again. And so when we talk about, the copper market exclusive, so the copper market for traditional end uses exclusive of energy transition and renewables and all that stuff, grid build out, you're still talking about conditions that would support a bull market. So supply, remember, is peaking and then coming down. And then you've got steady nearly 2.5% growth from traditional end uses.
Yeah.
The energy transition is on top of that. And so that's really where you get these gaping holes, between supply and demand. And as you said, it's not just about EVs. EVs have been strong, okay, but they've been, kind of underperforming slightly across this year in the US and Europe, and then outperforming significantly in China because China has a policy where they want to dominate, EVs. They don't want to be dependent on importing fossil fuels and so on. That's going to continue in China. But this energy crisis that you were talking about in Europe, that is going to absolutely galvanize policymakers' desire to, build out these alternative energy supplies. Okay, and part of that is, of course, going to be, on the LNG side, but a big part of it is going to be in renewables that they have security, like homegrown energy sources. And then all of that requires build out of grid storage because of how unreliable renewables are. And the build out of transmission networks. You've got policy driving the shift in residential from, I heat my home with natural gas. It used to be almost free in Canada. Natural gas was a couple dollars an MCF. It was stable there for a long, long time. Now it's you know, $10 an MCF and headed higher when it gets internationalized with LNG, as that becomes more of a global, you know, global traded commodity.
Yep.
And so it's the shift in residential over to electrification. It's the shift in industrial that's driven by the basic market mechanics on top of policy.
Yeah,
So
there's
this
a lot
is
of stuff. Yeah, we're kind of running over here time. So there's a couple good questions that John put on here. He said, you have 8 brokers writing research on the company. What is the average NAV for your based on last year's resource estimate? I think you covered that. That's at 24 to 29.
Based on the drilling we did to the end of last year, on the resource that we published, about $24 US.
And this drill program this year is going to add more to that, right?
Well, we're going to at least double the size of the starter pit and then
Okay.
triple the size of the indicated.
Yeah,
right?
I mean,
And you've still got growth beyond that.
so you'll put out like when is this next feasibility study resource report or whatever being put out?
We'll drill through the end of this year, and then we'll publish again like we did, you know, this year. We published in April. We'll publish again, you know, and certainly in the first half of next year.
Okay, so that would be the timeline for when it's really for sale, maybe.
Well, I'm not even.
Oh yeah, I won't answer. Okay, don't answer. I mean, it's always for sale. If a Chinese company comes and says we'll pay you $30 a share, it's for sale, right?
Yeah, we don't need to get full value. Like I said, we're realistic about the market conditions.
Yeah.
You know, we don't need to get 100% of net asset value. We got a strategy with the spin out where we're going to make it up to our shareholders in time. But you know, we're not selling in single digits. I mean, that
the sales price is a lot higher than the current share price. That's for sure.
It'd be malpractice.
Yeah, be great. And you've got the cash, and you've got the additional cash coming in from the warrants that gets you to the finish line, right?
Yeah, man, we've never been concerned really around funding with the shareholders that we have, long-term supporters and so on. We've got ample access to capital.
Yeah. Well, the terms I use, you're debt free, correct?
Yeah, absolutely. Debt free.
Debt free. It's all funded by equity, and you got a lot of running room. I mean, you got a lot to do, even if the market isn't ready to sell right now. You got a lot to do, and everything you're doing is hopefully adding more value to the asset that when the sales point is correct. When
Absolutely.
the sales point, when the time is right in the market to sell, you're ready to show to open the data room and get this thing sold.
Absolutely. Yeah. We have no problem doing that. We've done that literally in every example where we've had a world-class asset in the Augusta group. We've dealt with a 50% plus correction. We just put our heads down. When you got a world-class asset, you got the funding you need, you just put your head down, you add value to the asset in terms of growing it, and then you de-risk it. And that's what we're going to do here. It's the same playbook.
Yeah, you don't have anything hanging over your head. You got to sell it or something. That's the good thing I see here, that you don't have, because you don't have any debt. Hey, when you talk about the spin out of all those, see, when I heard you at our luncheon talk about spin out, I thought you meant spinning out the stuff that wasn't in Ecuador. So you're talking about spinning out everything other than the Warintza project itself, like on this map, right? All that stuff that's green and yellow, Cora, Betty, whatever.
It'll be as much as we can get away with, Dan.
Yeah, I mean,
Absolutely.
now that's part of the negotiation. Probably they're going to see the potential expansion projects here themselves, so they may bid. Their bid may include everything in that big box, right?
It all depends on the negotiation. I mean, if the price is
right, it's just negotiated, right? Got it. So, but when would that happen? You're going to do that this year, or you're going to wait until you're ready? Really think you're ready to sell?
Yeah, we're still working on putting together the rest of the land package with our partners in government, but we basically have everything else. So we've done the corporate reorganization. We've actually split some claims where we need to, and then got all the legals and everything in place. So there's a bit more work to do on it, but we basically, when there's a transaction for the company, we'll have ourselves in a position to spin that out.
But so is Solaris Exploration actually been created, the company?
Yeah, absolutely. And
oh, okay.
Not only that, like we've reorganized internally, we've gotten tax advice and structured it properly. There's a bit more work to do, but we'll be ready to go when there's a transaction.
But that's not public right now. So what's going to happen is the existing shareholders, when you decide to take that thing public, you're going to spin out, and those shares are going to be distributed proportionately.
Absolutely. Yeah, that's what we've done historically, is just spin out 100% of the shares and then list them.
So then when you sell the rent, so the existing shareholders of Solaris Resources would get the cash from that sale, but they'd still have all the expiration upside in the shares of the other company.
Absolutely. Yeah. So
Yeah, that sounds cool.
It's a 2-for-1.
Yeah. All right. Well, I will say we need to end it there. Probably way over. We've lost some people on the call, but we did record this. We're going to send this out to our global membership. And for those of you still on the call, that's where the big bang for the buck comes from. We have over 500 global members. A lot of them live in Europe and Asia. So they sometimes, because of timing, can't get on these live calls, but they're going to get this replay link this afternoon. And I think there's a lot here a lot of potential here for us. So this sounds really good. So I'll just thank you, Daniel, for the presentation. That was great. And we're going to keep watching the company. And, as you cross different milestones, maybe as you get that, year-end updated resource report, we can do this again.
It'd be my pleasure to do so. Thanks, everyone on the line. Really appreciate it and look forward to speaking again.
Okay. Thank you.